Howdy everybody, welcome back again. We have a video dealing with ratio analysis. It's really starting to feel like the old Bill Murray movie, Groundhog Day, where we do the exact same thing over and over and over again. But you know, we haven't been doing quite the exact same thing over and over again because we've been talking about different types of ratios, and hopefully you've been keeping a little sheet, marking down all the different ratios and writing down how to calculate them. Keep that all in one place. It's going to be very handy. And add to it with the ratios we're going to be talking about right now that deal with profitability. Now, you know, making a profit is the name of the game in business. Profit is simply when our revenue exceeds our expenses. And whatever the activity might be, we usually think of profit overall, the overall profitability of a company. And there is no more profitable business in America than good old Apple Corporation, maker of the beloved iPhone. Now, you take a look at their income statement, you can see they got sales minus expenses equals net income. They're pulling down in fiscal year 2022, $99.8 billion. With a B in profit. Not just sales, I'm talking profit. After all the expenses are considered, they are earning $99.8 billion in profit. Wow, very profitable company. So when we talk about profitability, we're talking about how much profit we are earning on our sales overall, maybe our asset, and maybe the owner investment or equity. And so we can measure profitability in any one of those three different ways. And you can be rest assured I'm going to show you how to do that with the calculations in our video right now. Our general rule of thumb, regardless of what kind of profitability metric we are talking about, the general rule of thumb, more is better. More profit is better. And in fact, the only time more profit is not better is when it comes time to pay taxes, because you got to pay taxes on that profit. So if there was a perfect world, we could report super duper profits, but then tell the IRS, hey, we didn't make any money at all. That world does not exist. And so the general rule is basically more profits equals better. We want our profitability ratios to be high, higher, and highest. You always want them to be going up. So let's talk about those profitability ratios for a little bit here. We got return on sales, which we've also maybe referred to as net profit margin. We've got return on total assets, and we have return on equity. All of those ratios are going to help us evaluate a company's profitability and efficiency, how efficiently they're using their assets to generate profit, for instance. So that first one, return on sales, net profit margin, measures the percent of every sales dollar that is left over after all expenses have been subtracted out. A really simple calculation. Net income divided by net sales. We're taking the bottom line of the income statement, we're dividing it by the top line. And then, well, wait a second, didn't we do that already when we did vertical analysis? Yeah, we did. But now we put a name to it, so it's totally new and improved. Return on sales, aka net profit margin. We're taking the net income, bottom line of the income statement, dividing it by the top line revenue, total sales. So here we go. We got Apple. We got their income statement here. We got bottom line net income. We've got top line total net sales up there. Let's divide it out and see what we get. We're going to take 99,803 divided by 394,328. Again, these numbers are in millions. And you don't need to put the 6 zeros behind it, but when you say it, you would say like 99.8 billion, 394.3 billion, and so on. And so do the math right there. What do you come up with? I came up with a staggering 25.3%. Holy smokes. What that means, for every $1 that Apple has in sales, they put 25.3 cents in their pocket as profit after all expenses have been considered. For every dollar, they stick a quarter in their pocket. Wildly profitable. If you've got an iPhone in your pocket or maybe sitting in front of you, and you probably paid maybe $800, maybe $900, $600 for that iPhone. Think about that in context. of Apple's net profit margin or return on sales. 25%. What that means is if you bought an iPhone 14 and you paid $800 for it, you bought it from, I forget the trade-in credit, forget all that stuff. Let's just say you bought it outright, paid $800 for it. $200 of what you paid went right into Apple's pocket. It's profit. $600 went to cover the material for the phone, the assembly, the labor, the marketing, and all the other stuff. $200. Man, I'm not saying you got ripped off. I'm a generic phone guy. I got my 4 models out of date Google Pixel phone here. I ain't fooling with no iPhone. Unless I get a raise maybe. So, to put that into context, also comparing it to maybe another business that you've been to. You shopped at Walmart before. Let's calculate Walmart and their return on sales. You've got their income statement right here. We've got net income at the bottom. We've got total revenues up here at the top. We're going to divide net income by total revenues. Go ahead and get your calculator. Make that happen. And I'm going to tell you, you don't need to redo the math. That number is correct. 1.8%. You do not need to adjust your TV. That really is Walmart's return on sales, their net profit margin. For every dollar Walmart sells, they stick 1.8 pennies in their pocket. Man, not nearly as profitable as Apple. What's going on there? You think about Walmart. I could go to Walmart, and here in Walmart, I could go to Kroger. I could go to Target. I could go to Ollie's. I can go to Aldi's. I can go all kinds of different places to buy what I need. I could buy online through Amazon, and I got all kinds of options. Therefore, Walmart is kind of limited on how much they can charge me. I got lots of options. Plus, Walmart's strategy is what? Always low prices. They're not making a lot of money when you will go through Walmart and scan whatever it is you're buying. If you buy a $1 candy bar, bloop, you scan it. They're making 1.8 pennies on that sale in profit. Apple, on the other hand, they've got quite a bit of pricing power, don't they? For a lot of people, there is no substitute for the iPhone. They've been using them for years, and when the new one comes out, they've got to have it, and they would never, ever consider walking around with a Google Pixel phone. They would be so embarrassed. It's just a black little brick. It's not cool. It doesn't have the logo on it. And the 8 cameras on the back, so I can make a movie with it. I'd never do that, right? So Apple's got a little bit more pricing power. They can afford to charge an extra $200 on top of whatever it cost them to make the phone and make a 25% profit margin on that phone. So, profitability ratio number 1, return on sales, aka net profit margin. We're dividing the bottom line net income by the top line revenue to find out how many pennies per every dollar of sales that company is sticking into their pocket as profit after all expenses have been considered. We can also look at profitability as a function of return on assets. How much profit are we making for every dollar of assets that we own? Obviously, if we have assets, we want to make money off of them. Otherwise, what's the point of having them? We've got buildings, we've got machinery, we've got equipment. We need to be generating sales with those assets. So what kind of return are we getting on the assets that we've employed? Let's take a look at that one. Return on total assets measures the profit we generate for every dollar of assets we own. Apple goes out, they buy assets. Are they making money off of them? We're going to take net income and add to that interest expense times 1 minus the tax rate. And you say, oh my gosh, no, don't freak out about that. I'll explain that in a second. And then we're going to take that numerator and divide it by average total assets. So that weird wonky looking part, you know what net income is, but now we're going to have to take interest expense, multiply it by 1 minus the tax rate. What are we doing there? Well, that little red box, that part of the calculation represents the after-tax cost of interest, the after-tax cost of borrowing. That applies to acquiring assets. Has nothing to do with how efficiently we use the assets once we get them. And so we need to strip out that interest expense. We're stripping out the part that deals with the leverage and the financing of the assets. It doesn't have anything to do with how we use them and whether or not we're making money on them. So we're adding that after-tax cost of interest back in to net income. It's been subtracted as an expense. Now we're adding it back in because it really has nothing to do with how efficiently we're using our assets. It has to deal with how we finance them. So we're going to add that part back in. That's what that part right there is. Now, we may have to do a little bit of digging. If we're looking at publicly traded companies and their financial statements, sometimes it's not clear what the tax rate is. Sometimes interest expense is lumped in a whole bunch of other things. We got to dig it out. So if we look at Apple, I'm looking at their income statement here. You'll notice I don't see really a lot about interest expense. I've got other income and expenses right here. That's where that number is buried. Somewhere in that negative 334. I don't see anything about tax rate on there. And so you think, okay, well, I just can't make the calculation. No, you can still make it. You got to do a little digging into the notes for the financial statement. In your homework, you won't have to do that. It will tell you. Cengage will say the tax rate, and they'll say interest expense. And you'll just plug the numbers in, and you'll live a very happy life. But in the real world, you got to dig around a little bit in the notes. Notes to the financial statement for Apple, I found, there it is, interest expense, $2.931 billion. And hey, look, I've even got a tax rate. Effective tax rate for 2022, 16.2%. I got a tax rate. I've got the interest. I am good to go. And there's my net income. That's everything I need to make the calculation. I have my balance sheet. I also need total assets. And I'm going to, again, take an average like we talked about in some of our other videos. We're just going to add the beginning and the end together and divide by 2. A lot of numbers to keep track of there. I'm going to go ahead and put them all in one place. I've got net income, the interest, I've got the tax rate, I've got beginning and ending total assets, and I've calculated the average. So, our calculation, return on total assets, net income plus the after-tax cost of debt. Interest expense times 1 minus the tax rate, divided by the average total assets. We just start subbing in numbers, we did 99,803. We'll plug that in for net income. 2931 multiplied by 1 minus 16.2% divided by the average total assets. Take that one step further, and we get 0.838 or 83.8% when we take 1 minus 16.2. And so we've done the math there. Go ahead, math it all up, and you should get 29.06% when you put all that together for your calculation. Meaning, for every dollar that Apple has invested into an asset, they earn 29 cents. For every dollar of an asset, they're earning 29.06 cents. So that seems like a pretty good return on an asset. Maybe you've got some money sitting in your savings account at the bank, and maybe that money is earning 0.014% interest or whatever ridiculous amount the bank is paying. Very little in that just regular bank savings account. And so your return on assets is 0.014%. Apple's, on the other hand, is 29%. You are not the same. Profitability ratios, return on sales, we've covered that one. We've covered return on total assets. Let's go ahead and do return on equity. And again, all these ratios are helping us evaluate the company's profitability, efficiency, and again, all the ratios, we want them to be high. We just calculated Apple's return on total assets as being 29%. Guess what? Next year, Apple would be thrilled if it was 30%, 31%, 32%, whatever the case might be. More is better. So finally, return on equity. We know equity comes from 2 different places for a corporation. It comes from the owners investing into the company, buying stock of the company on the IPO. It also comes from retained earnings. So return on equity simply measures the profit the business is earning on every dollar that has been invested by the owners. If I give Apple $1, I want them to earn money on that dollar that I've invested in them, right? And just like if I started a business and you invested in my business and gave me $1, you'd hope that I took that dollar and earned money with it. Net income minus preferred dividends, we're going to take that and divide it by average total equity. Now, the preferred dividends part. What is a preferred dividend? You may know that dividends are paid by a lot of corporations as a way of getting income back into the hands of the shareholders. We have common stock dividends, and sometimes a business has preferred stock as well. Preferred dividends are paid before common stock dividends. There are two different classes of stock. So preferred dividends are just dividends paid on a class of stock called preferred stock. Return on equity is normally presented as return on common stockholders' equity. If a company has preferred stock, we have to adjust our calculation by backing out the preferred dividend. So, if the company doesn't have preferred stock and doesn't pay dividends on the preferred stock, then this is a moot point. You don't have to worry about it. But if the company does have preferred stock and preferred dividends, got to make a little tweak to our formula. Again, your book will tell you, and so you don't have to think much about it. It will just tell you preferred dividends are $10,000. Make the calculation, go on about your day. Here's Apple's income statement. Again, we need that net income number. We got to go to the balance sheet, to the equity side of things, and we see we got common stock here, but we don't see anything about preferred stock. If they had preferred stock, it would be under stockholders' equity. So we don't have to worry about preferred dividends. We do need the total shareholders' equity. I put the pertinent information on one little table here for you. You can see the information there. Our calculation, net income minus preferred dividends divided by average total equity, 99,803 minus 0, divided by 56,881. What do we get? Go ahead and do the math. We get 175.5%. How can that be? It just sounds like a crazy number. You ever do your accounting homework and you're calculating something and the number pops up and you look at it and you're like, I don't think so. And you calculate it again, and it's the same number, and you're like, that can't be right. Something has to be going wrong here. I'm missing something. You think about 175.5%. What that means is for every dollar that I've invested into Apple, Apple is earning a return of 175.5% on that dollar. Doesn't seem like it's possible, but it is. And it has to do with how Apple is kind of structuring their business on the balance sheet side of things. And so we take a look here what I mean by that. I've got the liabilities and equity for the balance sheet. And I've got a 10-year gap here. And see, I've got 2011 and 2022. And then we skip 10 years to where we're at now, 2021 and 2022. Both Apple. And take a look at a few things here. If we look at the information for liabilities and equity, notice in 2011, 10 years ago, you don't see any long-term debt, do you, at Apple? And you see a whole lot of retained earnings. Not much debt, a lot of retained earnings. In fact, no long-term debt. Lots of retained earnings. We fast forward 10 years later. Non-current liabilities. We're talking $150 billion. So between 2011 and 2022, that 10-year period, Apple went out and borrowed at least $162 billion. It's more than that. They paid some of it back. Just call it $150 billion. Wow, what did they do that for? Why would a company go out and borrow $150 billion, especially one as profitable as Apple? It's a head scratcher. We're not driving around with an Apple car, and we don't really have a lot of new Apple products. Why did they need to borrow $150 billion? They haven't been expanding. Well, they wanted to pay dividends and buy back stock. And so they borrowed money to do that. Money at the time when they started borrowing it, people were making loans to Apple, buying their bonds that paid 0% interest. Basically, the market was saying Apple's credit was so good, the business was so good that they could borrow money at 0%. If I offered you the opportunity to borrow money at 0%, would you take it? You probably would. So they did. And they used a lot of that money that they borrowed to buy back their own stock and to pay dividends to the shareholders. As we can see, now look at their retained earnings. In 2022, it's a negative. They've got a deficit. You all know enough from accounting to know that when we have net income, it adds to retained earnings, right? Companies earning $100 billion in profit a year. That's how much they've paid in dividends and how much they've bought back their own stock. Literally took them from $100 billion in retained earnings to a negative amount. And so they kind of changed the way that they finance the business, the way that they've structured their balance sheet, and moved from very low debt, high equity to very, I don't want to say high debt because they obviously can pay this off tomorrow if they wanted to, but a higher level of debt with less equity in hopes of boosting returns for the shareholders. So kind of interesting to see that play out. Put it all together. What a long, strange journey it's been as we've gone through ratio analysis. You all have learned 4 liquidity ratios. You've learned 3 leverage ratios, and we just talked about 3 profitability ratios. Hopefully, I keep harping on it, hopefully you've got them all written down somewhere where you can easily look them up and apply them, because the value here, as I wrap up our discussion on financial statement analysis and ratio analysis, gang, the value isn't in just doing the math. I could find a 5th grader or a 4th grader and get them to divide one number by another. The math isn't the hard part. The value is in getting the numbers and being able to interpret them, being able to understand them, and being able to act upon them. That's where the value's at. The value's not in doing the math. The value's not really in memorizing the formulas. That's why I told you, write these down. Keep them at your desk and make them handy. Eventually, you'll get them memorized just by doing them over and over. But your goal to start out shouldn't be to memorize them. There's no value in memorizing them. The goal is in interpreting. The goal is in understanding. So make that your goal. And as you're working towards that goal, if you have any questions, I'd be happy to help you. If you maybe you're doing some ratio analysis and want to understand how everything fits together, hey, look me up, shoot me an email. I'll be happy to walk you through that anytime. We are done with our ratio analysis videos. There's still some other ratios out there. You'll learn more about those maybe in business finance, intermediate accounting, that kind of thing. But for now, we are ready to move on and talk about a new topic. So come back and find out what that new topic is. Until then, take care, everybody.